Hey guys, and welcome to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and today we've got quite a few interesting topics to discuss. I'm going to start with a company and a sector I haven't really covered yet on this podcast, and that's Walgreens Boots Alliance and the consumer discretionary sector. It seems particularly relevant, especially given the macroeconomic challenges we have, hence the interest and the decision to sort of explore it a bit more here. So Walgreens announced earnings this week on the 27th of June, and shares of the company were down nearly 10% on Tuesday. So the company's subsidiaries include obviously Walgreens, Duane Reade, Boots, Alliance Healthcare, and a bunch of other health tech companies. Earnings for their fiscal third quarter, were $118 million or 14 cents a share unadjusted, compared to $289 million or 33 cents a share from a year ago. So not only did earnings tumble year over year, but they also missed analyst expectations for the first time since July 2020. So that's a long run of consistency, but the fact that they've missed analyst expectations now, which is kind of post-pandemic era, is, some reason to worry. Now, main reasons that were given were obviously softening consumer spending due to inflation and a pullback in demand for COVID vaccines, testing, and COVID equipment. Now, I'm not entirely surprised that, COVID vaccines, testing, and equipment did worse. I'm not sure what, analysts were expecting, what the company was expecting, but surely this had to have been priced in. I mean, the number of vaccines administered dropped from 4.7 million to 800,000, which is an 83% drop. And I think that explains a bit more. Perhaps the magnitude of the drop was not sort of seen. 83% is a huge drop. That said, though, their revenue was actually higher than expected as a company, coming in at $35.42 billion versus what was expected at $34.24 billion, and that had increased 8.6% year over year. But where the trouble trickled down was in profitability. I mean, higher inflation, higher interest rates all contributed to a decrease in profitability, and as well as that, their operating income was significantly lower. I think another reason that the stock dropped nearly 10% was guidance. I mean, Walgreens slashed guidance from $4.45 to $4.65 a share to down to $4 a share, well, between $4 and $4.05 a share, citing once again challenging macroeconomic conditions and lower COVID-related purchasing as the main reasons. Now, again, I'm not too sure why, the lower COVID-related purchasing comes as a big surprise. I mean, Walgreens as a leadership team should have priced this in, or should have made analysts a lot more aware about the prospects here. CEO Rosalind Brewer mentioned that Walgreens was increasing its cost-saving efforts to $4.1 billion, which includes the $800 million in savings for fiscal 2024. So they look to shut down, about 450 stores in the US and UK. I think that's about 300 in the UK, 300 Boots stores in the UK and 150 stores in the US. And they'll look to optimize profitability for their US healthcare segment. Now, I will say this has been a tale of two sides. The leadership team has been struggling. I know Rosalind Brewer only came in 2021, but for the last decade, I mean, Walgreens has gone nowhere. The stock price is actually lower than what it was 10 years ago. And, now the leadership team has mentioned that this year would be a likely transition year and that they'll work towards extracting more value and driving profitability. But, as I said, I mean, I would take this with a pinch of salt. CVS is a far better run company, in my opinion. I mean, overall, I think for the next year or so, consumer discretionary seems a tough sector going forward. It could be much more than a year, but given that Jay Powell recently mentioned 2 rate hikes in a row is very much a possibility. It's not off the cards. companies need to take into account the cost of debt. I mean, interest rates increasing. I know Walgreens has a huge amount of debt, and that debt's not getting any cheaper. Higher interest rates may put pressure on the business and reduce spending from consumers, could just lead to sustained struggle, for companies like CVS and Walgreens. And I would say Walgreens in particular, just because of the amount of debt it has and how underperforming and underwhelming this company has been for the last decade. I mean, to hold, Walgreens has shown that they can generate cash, but they've just shown that they're not run very well, which is, kind of the big worry. And it's one of the reasons why, while this sector is interesting and it's definitely one to watch over this inflationary period, Walgreens Boots Alliance is just not a company I see myself getting close to. In other news, I wanted to take a 180 and talk about a company that actually did quite well this earnings, and in a completely different sector. I wanted to move to the semiconductor space. Micron Technology, the industry leaders in memory and storage solutions. So on the other end of the spectrum entirely, Micron announced earnings for their fiscal Q3, beating estimates, and revenue grew from, quarter on quarter, revenue grew from $3.69 billion to $3.75 billion. And, all of their revenue, gross margin, and earnings per share were above midpoint of the guidance range, which is great for the company, given the, recent news flow around it, the China chip ban. Share rose 3%, which is somewhat underwhelming, but, given that I'm a shareholder, but, I do have a good outlook for this company. CEO Sanjay Mehrotra mentioned that, the memory industry has passed its trough in revenue, and they expect margins to improve as industry supply-demand balance is gradually restored. And, he also mentioned that the recent Cyberspace Administration of China and the CAC's decision is a significant headwind that impacts their outlook and slows their recovery, which makes sense. I mean, there's good and bad news here. Good news is that he predicts that the memory industry has passed its trough. I mean, for him to come out and say that is a bold claim, and hopefully that means Micron's recovery and speed of recovery accelerates going forward. But obviously the CAC decision is very much against Micron specifically. So, I will say longer term, Micron Technology's leadership, product portfolio, and their operational excellence will strengthen their competitive positioning. Technologically, they're doing great, and they will continue to diversify their growth markets. And I think, their AI and memory-centric computing will help them drive growth. I mean, their forward-looking statements about the industry helped other Asian chip stocks rally as well. If we look at, shares of Japanese semiconductor company Electron, the shares rose 3.26%. The Hong Kong-listed Hua Hong Semiconductor increased 1.82%. South Korea's SK Hynix traded 1.67% higher. So overall, having a good impact on the wider industry in Asia. I also, with Micron, another reason I'm quite upbeat about this company is their investment in India. I mean, Micron, I know I mentioned, Modi's trip to the US, and this was one of the deals he managed to strike with one of these US-based chip companies. Micron announced plans to build a new assembly and test facility in Gujarat. It's an investment of about $825 million, and once that's set up, the facility will address demand from both domestic and international markets. Very upbeat about that. Now, why Gujarat? I mean, CEO mentioned that manufacturing infrastructure is good, it's a conducive business environment, and it's got a firm talent pipeline. The construction for that facility is expected to start in 2023, hopefully done in 2025, at least phase one of it from what I understand. But it's big news for Micron in India. With Micron's ban in China, it'll serve an equally big or growing domestic market, which should help its growth down the line as a company. And for India's economy, this continues their push for foreign investment, and It increases their manufacturing capabilities as well, adding more employment opportunities, overall contributing to India's growth as a country and a manufacturing center. Now, within the chip space, for U.S. chip companies, there remains some growing tension, with the new possibility of an AI chip export ban that was somewhat spoken about this week. I don't want to get too much into the politics of it, but it does affect companies like Nvidia and AMD because China currently represents between 25 to 30% of total revenue exposure for both companies. Now, Nvidia did mention that they see permanent loss in being able to tackle one of the largest markets if these restrictions are imposed. Then again, China controls a lot of supply of products to the US, and, I do suspect this may trickle down into some sort of economic warfare, which could get pretty messy if companies like Apple and Tesla start to get affected. I mean, we don't want economic warfare, because if economic warfare has shown us anything, it's the people that come out worse off are not the companies or not the politicians, it's the consumers. And as consumers, I think we can all unite and say, we want what's best for consumers in as many regions as possible. So I think this political game needs to ease up, and hopefully it does. But it is somewhat of a worry, because it could have a snowball effect, a domino effect, and one country could react to the other, and it just could get messy. The last thing I wanted to just briefly mention, it was more because of how interesting it was to me, but the USDA has now given the green light for lab-grown meat to be produced and sold to consumers. As of now, only 2 companies, which are Upside Foods and Good Meat, have been authorized to sell their chicken products to consumers. So this is interesting. I mean, what exactly is lab-grown meat? Some people may be wondering. It is meat that is developed from animal cells and grown with the help of nutrients like amino acids in massive bioreactors. So is this actual meat? Is this actual non-veg, or is this something like Beyond Meat or Impossible Meat? Consensus is it's actual meat. I mean, it is. It's scientifically, it's actual meat. The cells used are actually cells from chicken. So it is actual meat, but I will say the industry has a long, long way to go. I mean, current prices to produce this meat, from what I was reading, are just way too high. So for these companies to see any sort of profits as an investor, it may be a long, long way to go. And while, a small regulatory hurdle has been crossed, this is only crossed for chicken. There are many more to go. We need these hurdles to be crossed for beef, pork, and other type of animal proteins, respectively. We don't even know what it tastes like. I mean, we can go by what we read from other people's opinions, but I read things that people said about Beyond Meat and how it tastes like beef, but let's be real, we can all agree Beyond Meat tastes like Beyond Meat. It has a distinct taste. It does not taste like beef. It does not give the satisfaction of beef. So we don't know how this lab-grown meat would actually taste. Would it taste any different to the chicken we eat now? Is it healthy to eat? It seems ultra-processed. I mean, we know the negatives of processed food. How much would it cost to consumers? There are a lot of unanswered questions around many things: the industry, the product, the companies, who the leaders are. It's just an exciting bit of news that I thought, I'd share, and mainly the news revolves around the regulation of it. And I would like to say, I mean, given the opportunity, I think Singapore has some lab-grown meat allowed to be sold, but I'm not too sure. I'd have to double check that, but given the opportunity, I will definitely be trying lab-grown chicken as soon as I possibly can, or any forms of lab-grown meat, just to do a taste test comparison. And, the week I do that, I surely will let you guys know. But that wraps today's episode. If you made it this far, I thank you for listening. Once again, I'm Anurag Birla, and this is Finance Now.